Joining us now, Bill Dudley, former New York Fed president. We also, Mr. President, Mr. Former President, Bill, we also had Austin Goolsbee on last week talking about core inflation being around 2.8%. Does it make sense to you with the 10-year ticking higher? Does it make sense at this point to continue cutting, or does that mean we're just moving the goalposts on inflation?
So I think Powell's view is that inflation is going to continue to come down, but it's going to take a little while to be fully realized. He talked about the fact that shelter costs are still going up pretty rapidly, but that's a lagged response to the fact that it takes time for rent prices to reprice lower. And he's also concerned that the labor market is, not that strong. So his view is that the policy is still restrictive, the labor market is still vulnerable to weakness, and so heading in the direction of neutral is still the right course. I think the data, though, is obviously causing problems for them because the economy has been persistently stronger than expected and inflation has been stickier than expected. So the big debate in the market now is does the Fed cut in December? The market basically says yes, but not definitively. And then their view is that maybe the Fed will take a pause after that to wait for more information.
Bill, that dual mandate is a total pain, is it not? I mean, really, when you try and parts of each side seem mutually exclusive. It's not an easy job for anyone to try to navigate.
Well, you're trying to get to the tightest labor market you can without having an inflation problem. So you're sort of balancing these two objectives.
It seems really difficult. What does the move higher in yields on the 10-year? What do you attribute that to, since that jumbo cut of 50 basis points and the election? A little bit of both. There's still some residual inflation fear, and also, I don't know, maybe some trepidation on what a Trump presidency means for the deficit?
Yeah, I think the big driver is the fact that the economy is stronger than expected. And so people think the Fed's not going to cut rates as far as they thought before. If you go back a few months ago, the markets were priced for the federal funds rate to fall to around 2.9%. Currently, the trough in the federal funds rate looking at it in 2026 is 3.8%. So higher level of short rates translate directly to a higher level of 10-year Treasury note yields. But I do think the fiscal is an issue. And the fact that some of the Trump proposals on tariffs and deportations could also be not only disruptive to the economy, but could push up inflation, is probably also weighing on the market. If you look at what's happening, it's partly real rates have gone up, but it's also partly inflation expectations. So the market is, I think, rethinking about the idea that the Trump policies are going to be conducive to low inflation. And I think the tariffs are the biggest risk there. If you raise tariffs by 10% across the board, 60% for China, that's going to definitely drive import prices. And the increase is going to be a lot larger than it was last time, because the tariffs increases during the first Trump term were very modest. They went from about 1.5% of imports to 3% of imports. Now we're talking about something like 3% of imports to 15% of imports, or 20% of imports, much bigger magnitude of increase.
And I just wonder, any comments on the relationship between the president-elect and the Fed chair? I mean, you appointed him. Do you think it's going to be smooth sailing? And can I throw your hat into the Treasury Secretary ring? Do you want me to do that, or no interest?
I think they have no interest.
That's cold.
I would say that the Powell is basically trying to keep his head down. He was very definitive at the press conferences. No, I'm not going to leave my post early. Plan to serve up my term as chair to May of 2026. And two, Trump doesn't have the legal authority to kick me out sooner. So he started trying to put that to rest. And then once we get to early 2026, we'll probably see a new Fed chair, and the speculation will start about who that is and how friendly will they be to the Trump administration. There's a reason why we want the Fed to be independent, though, because it's been shown pretty clearly around the world that a more independent central bank leads to better outcomes on inflation and employment. Right. If you don't have an independent central bank, then the monetary policy gets whipsawed based on the election cycle, and that usually doesn't lead to good outcomes.